Obviously you design and test robust trading strategies. How could that benefit institutional investors and money managers? I mean, obviously, I'm not au fait with all the sort of types of traders and money managers and institutional money out there, how they place money or whether they trade themselves. But how could strategies and systems like yours benefit their company, their CTAs or money management? I mean, how can you see it adding to what they're doing already?
Sure. Well, ultimately, there's a lot of ways to look at that. So there's a question of whether or not, just because they're a professional doesn't mean they're performing well. So there's a question of whether or not, whether they need to enhance their performance because they're not doing well, because they're just not doing well. Everybody wants to always enhance their performance. That's anybody responsible would certainly be on board with that. That's one of the things. I mean, these strategies are, they're proven, and they can be, and they're high performance. So it's just a matter of whether or not, in all likelihood, they're probably not going to correlate with almost the stuff we have. Probably is not really going to correlate with anything they currently have, because I mean, I know how different range it is.
So
there's that aspect of it.
Yeah.
So there's other things as well, but you got a question.
But with most managers, then, I mean, in your experience, there's the individual traders. There's the private traders trading their own money. There's, like me, there's traders who are in charge of, amounts of money from institutions, a few million or more. And there are money managers who place money with different CTAs and different trading entities. So, I mean, what would you say to those people? I mean, how easy is it for an individual trader working for a larger company to adopt, several of your strategies and incorporate it into their trading? Is it a very bureaucratic sort of process, or can they make that decision by themselves? And what's the process they have to go through?
Well, if they're a trader working for any other entity, it's really quite variable. The bottom line is, it depends. Yeah, a guy who's a very successful trader, and who has a profile of being eclectic, using a lot of different kinds of strategies, and actually has a profile of actually using outside suppliers as well. Mm-hmm. It might be easy for that guy. A guy who is just starting out, who's struggling, I don't care how good the strategy is, how good our stuff is, his credibility is not very good. So, whether or not, our stuff might be tainted in the eyes of his our stuff might be tainted in the eyes of his manager by the fact that this guy is just not a very good trader. So that could be a hard sell. But in terms of I mean, I know a lot of the large institutional CTAs are really very structured, extremely structured. So they would have to go. They might have to go through a process. I mean, I know years ago, I provided some technology to a guy who was a prop trader at a firm where I kind of knew the guy because I knew his father, and I knew him a little bit, and we had a pretty good chemistry. And the trader, was not doing very well, but I guess the guy who owned the firm, he was a very good trader, and they were doing very well. So he was feeling a little bit more flexible, shall we say, and he wanted to help this guy out. So he basically fronted him the money to buy like $50,000 worth of stuff from me. And true to form, the guy wasn't a good trader, and he managed to screw up that too. So it's highly variable. I think it's probably the kind of thing where, you know, I mean, I'm not really quite sure how you'd actually. I know that there's some firms that actually just front traders, and they'll front them with, you know, starting with $2 million and they'll go up to $200 million or things like that. Millennium is one of those kinds of firms. So, you know, they would be looking at what we offer in terms of what we are offering, not in terms of, you know, I'm not sure they put it. I'm sure they would put it in the lap of a trader. I think the place where it could be really the place I think this could be extremely helpful would be there's a lot of prop firms that have small traders, you know, guys that don't trade, maybe they trade 50 or 100,000 or less, maybe a couple $100,000. And, you know, a lot of them are, you know, a guy who used to work for me actually worked for one of these firms. And he basically, the way he referred to it was, he was scraping a lot. You know, he was looking for ticks here and looking for ticks there, and, you know, already and stuff like that, doing spreads. So it kind of depends on, you know, whether or not a lot of these firms, pretty much the way they think about it, the prop firms think about you eat what you kill. So if you can't trade, you're out of luck. But some of them actually kind of pretend or actually will offer support to their people. So for example, if we did an installation for somebody and gave them provided them with 10 seats, they've got, like, you know, 10 or 20 traders. These guys could actually, a lot of these guys would specialize in a market or two, so they could really go and, you know, either utilize what we have us do something for them, or they could actually use the technology to create their own stuff. We do it for like an institution like that. We provide them like, if a firm bought 5 seats, for example, it'd be 25,000. It would be $30,000, and then we provide them like with 10 hours of phone support. So it's kind of a very, I mean, there's not really a hard and fast answer. One size does not fit all. And I'm sorry, I kind of went around, and it seems like it was so many ways to look at it, but there are a lot of ways to look at it.
Yeah, no, I can appreciate that. I mean, it's a good answer, but there's lots of, like you say, different people's approaches to the market, isn't it? So, but family offices is not something that I know a great deal about, but these are obviously more private. They do have different ways of trading, from more discretionary to, you know, longer term investments. In your experience, do you know much about family offices and how they operate, and do they use these automated algorithmic sort of trading strategies?
I do know a little bit about them. That too is quite variable. You don't have, I mean, let's put it this way: when a family office has, if it's for a single family, and let's say they have $10 billion in liquid assets, because you can't really, I guess the economics are such that you really can't economically afford to have an individual family office if you have less than, you know, $100 or $200 million. So then that gets to be either multifamily offices then for people with smaller amounts of money, like 25 or 50 or something like that. Yeah. But if a guy's got $10 billion, and if it's one individual or a family, and they have $10 billion in liquid assets, you know, the simple truth is they're not really interested. Most of them are not that interested in high returns. They just don't want to lose any money. So they already got a lot, you know. So they kind of just don't want to lose it. But that too is variable. Some of the family offices are actually very aggressive. So there are some that'll be like, you know, they'll be early adapters. There are some family offices that'll actually go with a manager after only 6 months of track record, because they make it their business. They're like talent scouts. They make it their business to find good guys, give them a try, and if it works out, give them more. So That too is variable, but you know, in between, there's all kinds of flavors in between them. From between the early adapters and the ones that just want to make, you know, like I was dealing with some people who wanted me to put together something which is basically they wanted to basically use one of my programs to basically just give some returns to because you can basically buy tracking of the S&P for pennies on the dollar now. That's so anybody can do that. But what they wanted to do is put together a fund that would 90% of it would track the S&P, and then the other 10% would use our stuff to really goose the returns.
Yeah.
And they felt that that's the kind of thing they could really offer. That's the kind of thing that a lot of institutions would be interested in. So you kind of have, you know, it's the only people who want to make 300 or 400% of their money are guys who don't really have a lot of money. they're looking to turn, you know, $5,000 into $1 million and very, very quickly. Yeah. And there's nothing wrong with that. I mean, I was just putting together our schedule now for what I want to do with our new program, and I realized that we're going to be you know, if a CTA generates 20 or 30% annualized rate of return, people think that's pretty spectacular, and I have a feeling that the returns we're going to be able to generate from this stuff are going to be way in excess of that. So it's going to be interesting to see if people, you know, I know my last public program produced 20% annualized rate of return for 12 years, and I had 1 year it was, you know, the 142% and all that. I haven't even thought about that because I'm just not interested. I mean, to create those kind of returns would really be, I don't know, I'm not going to say that. It wouldn't be terribly challenging at this point in time, in my opinion, from what I'm seeing from our testing and so forth, and the results we're getting. So I think we maybe there'll be a whole new thing that'll be just actually just amazing to people. So we'll see.
Yeah. We'll see. So this is obviously not just one strategy, lots of different strategies working as a system across, you know, what, 20, 30 different instruments or more?
Well, what I'm actually putting together right now would be 8 markets, and it would be 9 strategies per market.
Okay. So
because like we have with Ranger, there'll be a Ranger trio, there'll be a Blast trio, there'll be with something you've probably never heard of, a program we call Panther. There'll be a Panther trio, and they're all fundamentally different. They have some things in common because they'll use similar trend filters, because the ones we use in Ranger are actually really pretty good. So until I can figure out some new ones, we're gonna stick with the ones that we know really work well, but they have different entry mechanisms entirely. So anyway, so I don't, you know, it's you know, but the thing is that one of the things, you know, when you asked me this question before by email, I realized that one of the things that people just really don't, you know, one of the things that if people are doing discretionary trading, it's manpower intensive. So if a prop firm has got, if a hedge fund is all discretionary trading, they have to have, if they had a couple $1 billion, they might have to have 10 or 20 traders to handle all that stuff, because you just can't, even with technological support, you don't really, you know, I mean, I would never, unless I had some reason to believe this, I'd never really believe that a guy could actually trade 5 markets with discretion with any kind of real ability, at least fast anyway. If they're trading slower, that might, if they're really picking their moves. You know, like, you know, Bridgewater, they once said that if they had 15 positions on in a year, they were happy, because they put on huge positions, and they do it based upon, you know, I wouldn't call it discretionary. I would call it, let's call it discretionary with with hyper technological, hyper analytical support, because they really look at a lot of things before they make a decision to do a position. So there's that extreme, and then you don't need a lot of people. You need people who have brains to figure out what to do, but you don't really need people. You don't really need people to do the actual day-to-day stuff. But even then, they'll have trading desks so they can actually they'll manipulate their position. So they may want to lighten up or go heavier, or they trade around them and so forth. So a lot of them will have trading desks to handle that kind of stuff.
Yeah.
But the thing is, with automated, with this process that I'm setting up, I don't really need. We only really need a guy to watch it. There's and then they've got to be maintained. So that's one of the huge advantages is it's really scalable, because ultimately you can scale it very large. If you have, the more strategies you have, the more you can scale. So for example, in this case, we have 9 strategies, and each of those strategies in all those markets, since they're not going to be trading in the same, you're not going to have 9 of those things going along at the same price. This is not going to happen. So you can probably easily trade 10 or 20 contracts, or you can trade 90 to 100 contracts done without too much problem. So there's the scalability issue, and there's the manpower issue. You have much less need for manpower with automation.
Sure. So you're talking about obviously the strategies you've developed. They've got several different markets. Then people who could use them. You've got the individual trader. You've got the individual trader who has a significant amount of money, who could trade several of these strategies across several commodities or instruments. You've got family offices. You've got institutional sort of traders who could definitely use a lot of the strategies you've developed. But then you're also talking about your own sort of venture and a fund. Obviously you've been involved with funds before with spectacular performance, but you think from your back testing that what you've achieved now, the testing would suggest you're talking about significant returns in the sort of markets you're discussing with 9 strategies each, and that's a fund that anyone could sort of invest in.
Well, when it becomes a fund, yeah, it won't be. Usually, again, this becomes. I'm actually more interested in having a large fund that can take a lot. They can take a lot of smaller investors. Like my lawyer, when I did the last hedge fund, you have to realize in the hedge fund business, let's put it this way: there's a lot of people in the hedge fund space, investors and hedge fund managers, who are very snobby. So, and they don't really want to be associated with it. They don't want to have. Sometimes they think if you have he said I shouldn't accept I should set my minimum investment to be something like, he wanted to be like I think even $1 million. And I said, I did that last time and I don't want to do that again. He said, you always have the discretion to accept less, but I'd like it to be for at least no more than they say $50,000 or $100,000 for minimum investment.
Why is that? Do you think that? I've known you for a while now, and I think what you're going to say is that smaller investors have got a really rough deal from larger institutions where they've invested. It's obvious to me. I've been trading a long while, and the charges were significantly higher years and years ago. But even with funds nowadays, the structure is often 3% sort of management charge, 4%, and then all sorts of charges mixed in with that. So, like you, if you feel the same way, I think small investors have got a very rough deal. They've been excluded from very good strategies, very good systems, and the larger investors, if you're investing a significant amount of money in a fund, then you can sort of manipulate it in a way that is not right for that fund. Is that how you feel?
Well, no, I mean, I mean, let's put it this way: when people have a few $100 million, they can kind of get whatever they can usually get kind of whatever they want. So if you're at Goldman Sachs, for example, they literally have tiers of the level of quality service you get based upon some of the you don't really start getting the really good stuff until you have at least $20 million there. So and if you only have a couple $1 million, you'll get service, but you're not going to get. I'm not really quite sure how it really is different, but I know that there are differences in what they will provide for you. So I think it's just kind of I would just like to see people who have we're walking our dogs, and I was talking to a guy who asked me what it was that I did, and I told him what I did, and he said he trades. There's a lot of it's sort of like the stuff they have at some of the stock brokerage firms. I said, no, not like that. The stuff we have actually works. So I mean, people are sold this bill of goods that you can actually look at some charts, look at some indicators, and make money trading. And I think that's it's true, you can, but most people can't. So I think I know going way back. There are always people who are promising the sun and the moon, and delivering not delivering that. And I think the colors have changed, the flavors have changed, but there's still a lot. They're providing these services that really aren't. They oversell. They're really overselling what it is they're providing. Yeah. So I just don't. I don't think. I don't think the average guy can really. I don't think the average person, unless they really, and this because you went through this, but the average guy, unless they really make a really in-depth study of what's involved with being successful at trading, they're probably not going to have any success with it. So that's one of the reasons why getting a strategy that's been put together by somebody who knows what he's doing really changes the whole ballgame. You don't have you don't have to. One of my customers mentioned to me a couple of other people he's bought things from, and he said, and they're okay, but he says your stuff your stuff performs so much better than them. I think I'm probably going to stop using them because this stuff performs so much better. And I'm not trying to brag here, but I'm just telling you what he said. I don't. So I think it's always in the investment space. It's always been a tough game for the beginner, and it's you went through it. You know what it's like. So you survived it. A lot of people don't. a lot of people don't come out the other side of it. A lot of people start out with a lot. They start out with not enough money, and they just don't. There's just a lot of things involved that people just don't understand, and they just don't. And to some extent, I'm not even sure there's that many places where they can really get reliable information anyway.
Yeah.
So it's kind of always been stacked against the individual investor. I'm not saying that you can't make it work, because some people do, but I think it's a lot easier to. I personally feel you're a lot better off if you're starting with something that actually works, as opposed to something that starting from scratch. You're just trying to figure it out by yourself. It's difficult. It's a long process. I've been doing this for a long time, and I had the benefit of having years and years of seeing, looking at different kinds of techniques before I ever decided I was going to do anything with them. And that was, most people don't have that advantage. They don't have that opportunity.
Yeah, some of my friends, and two in particular I can sort of bring to mind, started trading in the sort of bull market of sort of late 90s going into 2000, and it was literally you could buy anything and it would go up, and they thought they were geniuses, and obviously come the crash, their lack of trading ability was very evident. So I think it sometimes depends where you start, doesn't it? Sure. If you have if you have that sort of market that you can do anything with and buy and go long and you make money, you actually think that you know how to trade. Whereas you've been through, I imagine, every single market, well, for the last 30 plus years, and figured out ways to maneuver through them. So, why wouldn't you use something from somebody who's so experienced? So, yeah, I mean, I've definitely benefited from using your system. As you know, I used a fairly straightforward trend following system for a long while, very profitably, but then decided just to add another layer to it, and I've been really pleased with what I've done. So, and I know from talking to other people that run your strategies that they feel the same way. So yeah, I'm definitely looking forward to what you've got planned for the future, and would like to be involved in it.
One thing I wanted to add, because
yeah,
there's this, you're talking about getting involved in a bull market when you can buy anything that's going to go up. Yeah, it's important in trading to know the difference between luck and skill. And there's a story that it's a story that I always love to tell, because there was, like, in the first big crash in the modern era, which was in '87. There was a firm, and they were a prop trading firm, and in those days there really weren't. Now they're everywhere. There's lots of them. There weren't that many in those days, and they literally made, this is in '87, so multiply it by 4 or 5 for now. But they literally made $1 billion in the crash. And you know what they did?
No.
They closed their doors. So we got lucky. It's probably never going to happen again. Gave everybody big fat bonuses, and they left. Stopped. Now, I'm not saying that's what you necessarily have to do, but they knew the difference. And I've always said to people, if you spend enough time trading, you're going to catch one of those whoppers. It's going to happen. The number of people that I know who've done very well in trading, who actually got. I knew a guy who was a neighbor of mine who actually was he was an order filler, and he was an order filler in beans, and he was discretionary, like, because this goes back a long way, and he literally bought I think it was a soybean oil contract, and went limit up for 15 days. So these things happen sometimes. You can go the other way too. So it's the kind of thing where you just have to know the difference in luck and skill, and even if you're skillful, you still have to know. If you get, like, when we had that year and we made 142%, I was pretty stunned by that, and I thought, well, that's great, but I didn't know, I didn't expect to create 142% returns every year running. It was an unusual year, and we benefited from the crash in 7 and 8, and all those moves. I remember I bought a bunch of stocks in March of '9, when they went towards the bottom. And even though I've been involved with this for a long time, I was really watching that one, because when you're buying the bottom like that, you just have to. When you're buying the bottom like that, you got to keep an eye on it. But I remember years ago, speaking of the crash in '87, I remember I was giving a presentation in Cleveland, of all places, to an investors club, and I just showed them a chart. It was after the '87 crash. I showed them a chart with the stuff that I looked at, and I said, I know it's hard to believe this, but I can't tell you. The only thing I can tell you is I have every reason to believe this market's just going to go up. And even though you don't want to, even though it looks like a scary thing to do, I think it's going to go up. And that too was the bottom then. So and I sometimes, big picture wise, it's kind of easy sometimes. It's kind of easy to see when you're putting in a big top or a big bottom, if you're doing this long enough. But trading if you're going to trade for a living, you really need to be able to make money, every week, every month, every year. You know, it's in our business, like a lot of businesses, it's what the motto is, what have you done for me lately? And you're only as good as your last trade. So, you know, so I think it's one of those kinds of things where you have to recognize that you have to kind of understand the parameters of the way you want to play the game.
Yeah, yeah. And you know, obviously with what you design and develop, I mean, the amount of work you put in has always impressed me. You know, the number crunching that goes on, the design of the systems. You have a few tricks up your sleeve, and you apply them to the strategies, you know, very well, and they just seem to work. And the testing that you do, you find the parameters that are ideal for those markets. So yeah, you know, it's very impressive to watch. I don't have any other questions, Bob. Pardon?
It's fun.
Yeah, yeah, I can tell the way you talk about it that you enjoy it immensely.
Well, the thing is, you know, I mean, I just can't, you know, I've said to people many times before, I've never really, the systems that we build are like, you know, they're not, you know, people think the perfect trade is when you buy and you never have a drawdown, and you sell and you only maybe get a little bit of a pullback before you get out at the top. That's what they think the perfect trade is. Well, that is the perfect trade. But, you know, you can make a whole lot of money with imperfect trades. You know, you don't have to. So we've never really kind of built. A lot of people spend a lot of time trying to build the ultimate super system, and I just don't think that's really. I mean, you know, I don't think that's. I mean, I don't think. You know, maybe some people have done it. I don't know, but I just don't think that's. I don't think that's the most efficient way to go about doing it. You can, you know, I think the way we do it, where we use a lot of really good, high quality, robust systems put together so as to really, you know, minimize drawdown, is very efficient. And, you know, I just don't think trying to have one strategy that's going to pick every bottom and pick every top in one market is really. I don't think that's really very sustainable.
Yeah, I mean, like you say, that system may be out there somewhere, but you know, there are some very bright people in this space, and you know, as far as we know, that nobody has done that. Otherwise, they would probably have all the money in the world, and you know, trading would be not very sort of profitable. But there's lots of ways to make money in these markets, isn't there? Even, you know, a trend following system has returns and it's not perfect, and your systems have great returns and there are drawdowns. And I think it's, like you say, having a portfolio approach, having several different strategies per you know, per instrument, so that you can benefit from whichever way the market goes. Yeah, I think this idea that people just have one system and one market and they're going to make a fortune, it's just not like that. So you know, you need this sort of diversified portfolio approach with lots of different strategies. So is there anything else that you wanted to add about the sort of time scale for, you know, because I would quite, you know, a lot of people would quite like to get involved, I think, in the proposed fund. What's the time scale for something like that?
Well, it could be actually within the next few months, actually.
Yeah. Okay.
Like really, we found a way to actually even build systems faster than we do with Ranger Maker now. That's working. Yeah. We got the first confirmation that in fact the new technology is actually working correctly. So yeah. And that's that's going to be important, because one of the things, you know, ultimately for the fund, it's going to trade everything. So but that's when it will be much bigger. So I want to make sure we have the technology in place, and plus also, so there's some technology issues. So that's, but you know, because I actually have most of the stuff run for a small version of this actually, it says that's actually that could be very actually pretty close, really.
Yeah. Well, that's good.
Take a bigger one. The way we do this is we just kind of keep on, we get a basic portfolio that we feel that we know we have confidence in, and then just keep on adding to it.
Yeah.
Building it out.
Yeah, sounds quite exciting. I'm looking forward to that.
Good.